Well, good afternoon, everybody. Thanks for coming. It's good to see some familiar faces that I haven't seen in a while, and some new faces. So that's a great start to the day. We're a Canadian junior oil and gas company based out of Calgary, Alberta, Canada. We're a small cap company, and currently the small caps are pretty much trading at the lowest multiples in just about any space in industry right now than any other time in history. But we're a bit different as a small cap company. We're a small cap company that has strong funds flow. We have strong free funds flow. We're profitable. We implemented a dividend in November 30th of 2022. We're in a great spot. Couple that with the lowest leverage that I've ever been involved with in an oil and gas company in my 30 years in the industry. So, with that said, I'm going to jump into our presentation. Our strategy is to show top tier production per share growth, generate strong free funds flow, and strong free adjusted funds flow, keeping leverage conservative and creating our return to shareholders and continually looking to increase our returns to shareholders. The free funds flow has been allocated towards dividends, tactical strategical acquisitions, and we do have a share buyback program in place. We're a technically focused team. I'm an engineer by trade. We got a strong track record of delivering per share growth through multiple cycles. And I got a page that I'll show you guys about what we've delivered since we went public in 2016. Of course, 22 was a great year. And we averaged $94 US WTI price that year. We had record production. We had record funds flow of $130 million, free funds flow of $53 million, reduced our debt by 59%. We ended the year at about 0.2 times debt to EBITDA. I've never been below 1 times debt to EBITDA my whole career. With that, we'll jump into where we sit corporately. This year we're going to do about 9,100 BOEs a day. We're going to have a little bit stronger oil and natural gas liquids ratio. We're going to drill approximately 17 net horizontal wells. We've got strong reserves across the board. 17 million proved, developed, producing, all the way to 61.8 million BOEs of proved plus probable. We have 90.3 million shares outstanding with 93.2 fully diluted. The difference is just incentivized stock options. Very clean share structure. We're currently trading a little lower than this today, but at $2.60 per share when we did our latest presentation, that's about a 235 million Canadian market cap, enterprise value of about $284 million. This is deep value, and we'll talk about that as we keep going through that presentation. So, we trade on the Toronto Stock Exchange under the symbol of IPO, it's a great symbol, and on the OTCQX, IPOOF. Now, we implemented our dividend last November. First payment was the end of November, 1.5 cents per month Canadian, or 18 cents a year. Currently, that's around a 7.6% yield. Our liquidity is pretty good for a small company. 360,000 shares the last 6 months. This was till the end of October, and very similar in the last month. Now, it has slowed down here recently, and that's been kind of consistent with the markets, I think, and specifically the small cap space. Just under 6% of our shares are owned inside with insiders and directors, and we have one main shareholder that's 22.5%. They've been with us since we started again privately in 2013, 14, and put more money in 16, and they've been with us ever since. We got a $110 million credit facility with Canadian lending institutions, probably as good a lending institutions as anywhere in the world, with Q3 debt of just over $40 million. This is my favorite slide. Top left corner is our production since we went public in 16. So we went public November 10th of 16. The light green in the columns is our light oil and natural gas liquids production. Our orange is our natural gas production. We have been growing 17, 18, 19 in a very difficult time frame every year within our cash flow, within our means. That's top tier production per share growth. The blue squares is our production per share growth. We've been doing that all through the years as well, except for, of course, 2020. Very difficult year to grow production and per share. The key for 2020 was just to survive. We did that. We survived. The things we did actually made us thrive. And we came out of the back end of COVID with the deals we did in 20 and 21, a better, more sustainable company than we did going into COVID. In fact, the best financial and operating position I've ever been involved with in an oil and gas company. Again, you can see our production per share growth in the blue squares in 21 up with the deal we did, small deal, and another one that we closed November 30th of 21 going into 22. Huge production per share growth. Top right's our reserves per share growth. If you grow your reserves on a per share basis in production, you will create value for your shareholders over time. As long as you don't use all debt and have too much debt, blow it up, things like that, which we haven't. That goes down to the funds flow in the bottom left corner. Again, 17, 18, 19, growing our funds flow per share every year. I think we were about just under 50 cents a share in 19. That was about 32 million Canadian. Under 10 million Canadian in 20. Like I said, just survive, which we did. We did a little deal that closed at the end of October in 2020 and another deal November 30th and 21. And you can see our funds flow and our funds flow per share creep up significantly to just under 70 cents a share in 21, all the way to $1.50 a share in 22. 130 million of free funds flow, or funds flow. Leverage. Our first full year in 17, 1.9 times debt to EBITDA, worked our way to 1.6 times in 19. Of course, COVID came with $10 million of funds flow or EBITDA, just kind of blew up that year. But back to 1.5 times in 21, all the way to 0.2 times at the end of last year. Like I said, the best financial position I've ever seen with any company that I've been involved with. The industry in Canada always ran 1.5, 2 times debt to EBITDA. That was the standard. The US was probably a multiple higher, 2.5, 3 times. You know what? It's not the same. We're running our businesses differently. That was growth for growth's sake. Wall Street, Bay Street basically told this industry, it's time to show return of capital employed, return to shareholders, which we're doing from top all the way down to us and smaller companies than us. Debt and equity used to be easy to get. It's not as easy to get. It's more costly. We're running a lot closer within our means. Part of the reason that discipline is why I think we're in the start of a multi-year oil bull cycle. We've been adding our reserves very efficiently. When I take a look at some of our oily weighted peers in Canada, when you look at the top left, our 2022 proved developed producing finding development acquisition costs, the blue columns there, we were number 3 in a group of our oily weighted peers. We were adding reserves in the ground for just under $15 a barrel. But our 3-year average, we were number 1 within that group at under $11 a barrel. The top right's our 2022 total proved finding development and acquisition costs. And it was about $24 a barrel, again, number 3. But over the 3-year average, we were just around $12 a barrel. So, at the top of our peer group of adding reserves over time. So, taking a look, if we put our forecast out there into 24 and 25, we're using 3 price scenarios. It's the top right corner, the chart there, 55, 75, 95. Obviously, we're just about done the end of the year. We aren't going to have $55 oil in 23. You can see the sustainability of our company and what we're trying to accomplish. The orange is our dividend, about 16 million Canadian a year. The purple is our estimated capital program. The green is the remaining free funds flow. So again, very, very sustainable to low ratios, or to low WTI prices. And what really makes me sleep well at night, again, is that low leverage. If you have oil prices that drop, we used to be running 1.5, 2 times, well, that would easily be 3.5, 4 times. Now, when you're 0.3 to 0.5 times, it doesn't really get higher than 1 times debt to EBITDA ratios. So just a great, great place to be. I'm from Calgary, Alberta. You can see in the Alberta map. Our main field of operations is the Pembina and the Williston Green Field. That's about a 2.5-hour drive northwest of Calgary. The main zone, with 85% of our production, the geological zone is the Cardium. I've been working in this field since the mid 2005, sort of 2007 range, so been working this for a long, long time. The northern play is the Pembina field. This is old oil field. You can see all the dots in there, that's vertical wells. This is the largest conventional light oil pool in Western Canada. Found in the 50s and 60s with verticals, delineated in the 70s and 80s, water floods put in place, other type of floods put in place or trialed. We came back in here in 2005 to 2008, and we started drilling horizontal multi-frac wells just outside where the vertical wells were not economic. So on the edges, but also deeper than the original zones that were produced with the vertical wells. In the bottom right corner, or left corner, is our decline profile from our reserve evaluators. Our proved, developed, producing reserves decline. Now, that's our base case. In 2023, that was 26%, and that would go to 18% in 24. Well, we drill on top of that. That gets us to low 30s. That's a manageable decline. I've been there in my previous companies. The shale guys have all been there. In the old days when we used to grow for growth's sake, you'd have $100 oil, you'd have $5 gas, we'd spend every ounce of cash flow, we'd grow like crazy. My declines in a conventional play that were, a little bit tighter than the normal conventional play would be in the 40s. Some of the shale guys would be in the high 40s, maybe pushing 50%. Not very manageable when the prices go the other way. Don't have enough cash flow to stay flat. Discipline is what this industry is doing as a whole, and it's actually really, really nice to see that. When I take a look at Williston Green, so this is a little bit smaller Cardium play than the Pembina area. We did a great little acquisition that closed November 30th at 21. That's in the bottom right hand. All the yellows are land position. We've been drilling significantly there since. Now, that doubled our land holdings in Williston Green. It increased our drilling inventory by over 90% here. It was very accretive at the time of the acquisition. 15% on a production per share base, 12% on a funds flow per share base, 17% on a free funds flow base, which again is very important. If I can do smart deals, higher free funds flow, I can return more to the shareholders. And very accretive on our reserves, 21% to 60% in the three categories. Reserves are our lifeline. They're a big part of our sustainability. So important to do. Now that was before what we were able to do and accomplish on this asset. It was 1,800 BOEs a day when we bought it. It's currently doing 38 to 4,000 BOEs a day on any given day. So we created value significantly. Not only that though, the commodity price went up quite a bit since then. So the funds flow accretion was significantly higher than what we showed at the time of the transaction. So the Pembina Cardium, again, we've been involved in this and I've been in this area forever. It's a large pool. You can see our land base there in Levin, in the yellow there. In the blue square, we did an acquisition that we closed in the end of October in 2020. There was no horizontal wells in those two properties. It was 100% property that we purchased from a senior Canadian company. We paid $1.9 million for that acquisition. We actually got our lenders to give us $1.9 million. WTI was still around $45 US. Our leverage was still high. That was no small feat. And that goes to show our good relationship with our lenders. We started drilling in the first quarter, in January of 21. Did our first 3-well pad. We also had to build a full oil facility to clean the oil so it would make pipeline spec and we could sell that. All of that came on at the end of March. We drilled our second 3-well pad in June of 21, came on at the end of July. By the end of September, the acquisition, the 6 wells in the facility cost us $12.5 million. By the end of September, that was all paid off. In fact, our operating income for the year 2022 was 22 million, or 21 was 22 million, and our operating income on this property in 2022 was 77 million. Great acquisition. These two acquisitions completely changed the way we look as a company, and again, made us into the best operating financial position that I've ever been involved with in a company. So, we're looking at growing continually organically, plus the potential with smart, strong, accretive acquisitions as we move along. These are our well costs and our economics of the wells we're drilling. I'm going to focus only on the Williston Green 1.5 mile Cardium horizontal wells. They're a little higher than this right now, probably about 3.6 million to drill, complete, equip, and tie in. So that's on the far right. We get around 310,000 barrels of oil equivalent in reserves. The IP90, that's our initial production over 90 days, or the first 3 months, it's about 325 BOEs a day. Over the first year, IP365, about 200 BOEs a day. You can see the type curves in the bottom right there of where they start and how they decline through the first year. So 50-60% decline in year one, but I got a good solid base decline. Shale is declining 80-90% in year one. At $80 WTI, we pay this out in just a little over a half a year. So really, really strong economics. We can't be in this industry and not talk about environment, social, governance type issues. We're a small company. We just put out our 22 sustainability report. It's on our website. So that's social, governance, and environmental and how we stack up. It's very important to do that as a public company, but not a lot of junior companies do that. The biggest thing we could do is reduce our greenhouse gas emissions, kilograms of CO2 equivalent per BOE, and that's what the top right chart is showing, that how we've been reducing it since 2018 into 22. We've reduced every year except for 2020. There was not enough money to be putting into reducing emissions that year. And then when you take a look at peers of ours that actually publish a sustainability report on their CO2 emissions, we're consistently sitting about number 2 amongst this group of peers, which are, their symbols are all in the bottom note number 2 there. So we're doing our thing. Canada's doing our thing. Basically Canada and Norway show up as number 1, 2, and could be every year a switch, as the most socially conscious, highest standards, government standards, regulations, and environmental standards of anywhere in the world. We really should be the producer of choice in the world. When I take a look at our 2023 forecast, we basically at our Q2 press release, we updated our forecasts of 23. We took the actuals to the end of July. We used $80 WTI for the rest of the year. Of course, we had that through August, September, and now a little bit lower through November and December. But $77 WTI, it might be a little bit less, 75, 76. That gets us $100 Canadian basically at the wellhead. I don't know, does anybody know what the Canadian dollar, the FX is today? About 73 cents. 73, 74 cents, yeah. It's been 72 here in the last little while. Bottom line is, I pay my employees, I pay our services in Canadian dollars, I sell our oil in US dollars. It's a huge boon for Canada, a huge boon. In fact, I've read a report from JP Morgan, economist out of New York, and he's basically telling people, like, you should be looking at Canadian oil and gas. It's got one of the highest free cash flow yields of any industry, higher than the US, lower because of the dollar, lower leverage than the US guys, and lower multiples than most of the US guys, cash flow multiples. I had someone in Texas ask me, well, what's the day rate of a rig? And I'm like, well, it's 18.5 Canadian. And he said, well, it's about the same for the similar type rig in the US. So these are all benefits. Not only that, we tend to pay lower royalties than they do in the US. We pay crown royalties, which typically are quite a bit lower, specifically over a payout period of 5% versus most Permian guys are paying 22-25% for the life of the project. Bottom line, we're in a great financial and operating position. Our year-end reserves, our reserves are 100% evaluated by a third-party registered evaluator. What I want to talk about here is our proved developed producing reserve case. It's about $3 a share. So $3 a share. We're trading 80-85% of that today. Proved developed producing is our blowdown case. January 1, 2023 production, blowing down if we didn't drill another well. That's what we're trading. Historically, the industry trades a lot closer to total proved, which starts adding undeveloped locations into your net asset value, okay? Total proved reserves by our reserve evaluators have to have a probability of 90% hitting that. That's what they are asked for. So a very high probability that you will get those reserves in the life of your company. This is something a little different. So this is all public data. This is a chart put out by an energy boutique investment firm out of Canada, Peters & Co. This goes back 25 years into 1998. The left-hand side is EV to DAC-F cash flow multiples, or multiples, which we'll just say cash flow for terms of reference. The yellow is junior companies over that time. The blue is intermediate companies over that time. The black is seniors and integrated Canadian companies. The shading on the behind it, it's WTI price over that time. And the WTI is on the right-hand axis, okay? Why are we trading at all-time lows? When you look at the far right, I got a red line in there. That's 3 times cash flow multiples. Juniors are trading 2.5, 3 times cash flow multiples. Lows of ever. The intermediates and blues were trading just with the juniors here in the first half of the year. They started breaking out. That's on the far right. They started breaking out in July of this summer. The integrated started breaking out, the seniors, in the middle of January, or the middle of 2021. You can see the black line would start breaking out. So the seniors and integrateds are 5, 6 times. The intermediates are moving their way over 4.5 times. Why is that? Well, you know what? There's no resource funds left. There is no resource funds. You have to wait for the generalists. The generalists are going to be conservative. The generalists started by getting into the large caps, the liquid stocks, to dip their toes in the water. That's why they went up first. In July this summer, they started putting money into the intermediates. Why you saw the intermediates start to break out. As juniors, we always break out too. Sometimes it's just a little bit lower than anybody else. So here's a couple of bull energy cycles. 2005 to 2009. This black line is WTI at $60, but people believed it was $60. The industry could do and make good money at $60. Do you see that red line? Well, that's a 6 times cash flow multiple where the juniors were bumping up against. The intermediates traded as high as 8 times, very similar to the large and integrates. We had the financial crisis in 2008, $140 oil, went down to $40 oil in early 2009. We had another strong cycle from 2010 to 2005. That black line at the top, that's $80 WTI. That's $80 WTI. The red line, 7 times cash flow multiples. Do we need to get there? No. Will we ever get that high again? I'm not sure. Bottom line is, if we get 4 or 5 times cash flow multiples, those are going to be solid returns. And we're paying you a dividend to wait till we get to that point. Peters & Co. just put out, these are the energy bull cycles. The red line is the one that they believe we're recently in. So we're kind of in year 2 to 3 of an energy bull cycle. Bull cycles tend to last 7 to 10 years, with the largest breakouts occurring in year 3 to 10. We're currently somewhere in this 3rd year of that cycle. Industry discipline to shareholders versus the high growth mentality that we used to have should provide a long cycle. The discipline there, OPEC plus, Saudi's got Vision 2030. They can't do that at $60 oil. That is predominantly it. It's a very simple story. Strong cash flow, a value play, deep value, low leverage, paying you a 7.5% dividend to wait until we start seeing some of these cash flow multiples expansions. Probably don't have a lot of time, but I have a breakout session after if you want to ask some questions. Yeah, Michael?
So your chart showed tremendous production growth in 2000, 2001, 2002. Seems to have slowed down a little bit, even though new well results are still very strong, pointing at infrastructure issues. So I guess my question is, what can InPlay do to address those infrastructure issues, or is it generally out of their hands?
No, I mean, that's a good question. I mean, this year was a difficult year in the fact lots of things going on in Canada. First and foremost, we had wildfires in June, and in the Pembina area, we had like 40% of our production shut in for, between 10 and 14 days. Some lingered on a little bit for better part of a month, and some wells went down when we shut stuff in. So that was an issue. Lots of third-party gas plant issues where we send our gas. So like 85% of our revenue is driven by oil and natural gas liquids, even though we're 40% gas by volume. But we do, instead of building gas plants, we need a lot of third-party gas facilities to take away our gas because we're not going to build.
With more than 6,000 small and micro-cap companies listed, if you're looking for the next Apple, then ChannelCheck truly is the orchard. It's an investor community where you can access independent Wall Street research, advanced market data, balanced news, corporate videos, and podcasts. You can even register to attend in-person Meet the Management Series luncheons, and to be part of the preeminent annual Small and Micro-Cap Investor Conference, NobleCon. And here's the best news. Since ChannelCheck is sponsored by the featured companies, premium membership requires no investment. It's absolutely free. So check it out. Log in today. Find out why ChannelCheck is North America's leading source of research on the companies that just may change the world.